Welcome to Beyond Wall Street, presented by Arixa Capital, where expert investors make their unique investment strategies easy to understand. I'm your host, Brzeski, and today I'm talking with Paul Slider, Managing Director of Underwriting at Calmwater Capital. We'll be discussing making loans to real estate investors of $10 to $75 million per loan secured by commercial real estate. I'm here today with Paul Slider. Paul, I'm really excited to see you and interview you, and I appreciate your being available for today's interview.
Well, thanks for having me. I appreciate it.
So let's get started with your personal background and how you came to be in the role that you're in now. Maybe just give us a little background about your career path.
Yeah, I think it's a pretty unique career path. I'm third generation military. My grandfather and father were military before me. After high school, I didn't know where I wanted to go with my life, so I just stayed in the family business, so to speak, and joined the Air Force. My father and grandfather were Army before me. I did 20 years in the military, spent about 12 years active duty, and I got out. I left the military active duty in 2005 after the Iraq War. Kind of got bit by the real estate bug and knew that I just didn't want to be a lifer in terms of the military. I finished out my 20 in 2013, but left active duty in 2005 to pursue real estate. Didn't really know where I fit in the first couple of years. Worked for a hedge fund for a little bit, then worked for a home builder before I found my way over to commercial real estate. From there, I knew that's where I wanted to be. Unfortunately, that was right in the middle of the great financial correction. So I used that time to go back to grad school, went to grad school, came out of grad school and wanted to be an equity guy, wanted to do acquisitions and development and all the fun stuff. But the middle of GFC, not too many opportunities in that regard. So found myself in the debt world, spent some time at Wells Fargo and their commercial real estate group, learned real estate from a big banker's perspective. From there, transitioned over to GE Capital Real Estate, learned real estate from, more of a bridge lender's perspective, a bit more challenging deals versus, Wells Fargo's deals. And then when Jeff Immelt decided to blow up, GE Capital, I went to Cantor Fitzgerald and worked and learned real estate from the commercial mortgage banking, the CMBS bonds, perspective. And I was there building out a credit platform for Cantor Fitzgerald and got tapped on the shoulder to come over and join Calmwater and help Larry continue to build the business. Larry Grantham, the founder and my boss. I've been here for 4 years, so good times.
Terrific. And I've also known Larry for a while and appreciate his input about things in the debt world, since we're both in the real estate debt world. But let's talk about Calmwater. What does Calmwater do? What kinds of loans does Calmwater make?
So Calmwater was founded in 2010 to provide real estate owners and developers liquidity during the great financial correction. It was a strategy that Larry saw an opportunity, given that there was just a lack of liquidity from the time that recession began, 2008, to probably 2011, 2012. So he came in and built that strategy up. And the strategy has kind of evolved a little bit, but it's kind of still the same bread and butter. And what Calmwater provides and its unique competitive advantages, it focuses on all, commercial real estate asset classes, bridge loans primarily, 2 to 4 years. But we provide, our clients, developers, owners with timing and certainty of execution. So whereas a lot of real estate lenders generally take anywhere from 4 to 6 weeks to close a transaction. Before COVID, we can close within 2 to 3 weeks. That's been pushed back a little bit now, given the availability of resources. And then we do a lot of work on the front side. So we provide our clients with certainty of execution. So we're not the type of lender that's just going to issue an app or a term sheet and figure it out in underwriting or due diligence. We do a lot of work on the front side. That way, a high percentage of our, deals, term sheets close exactly as they were apped in the term sheet. And for the ones that don't, something popped up during diligence that neither the client saw or we saw. And then we generally put our heads together and figure it out. But timing and certainty of execution is kind of how Calmwater sets itself apart in a crowded field.
And talk about a recent loan that you funded that's sort of representative of the type of things that you're doing in 2021.
Yeah, so we had this a sponsor in Texas that had an established track record in terms of owning and operating, Class B, Class C multifamily assets. It was last year, within the last 6 to 9 months during COVID. So obviously the lending landscape was still a bit restrained. And the sponsor had a significant track record, was buying a multifamily property off market, had an incredible opportunity to realize. I mean, as soon as he closed the deal, just buying it off market because the seller had liquidity issues, but they had to close within 3 weeks. So it was an asset that was owned by a foreign investor that hadn't really been proactive in managing the asset, but because the sponsor was Texas based and had a significant track record in managing these assets, he knew that he could unlock value that this foreign-based owner couldn't. However, he had 3 weeks to close the transaction. So in the middle of COVID, we have relationships in place that we've been doing business with for a long time, and we were able to get that deal closed for that client, that sponsor, within 3 weeks. So he was able to realize that opportunity, and he not only did he close the loan, he also paid us off before the loan matured.
So let's talk about that. What type of loan amount was that, and what was the maturity of the loan as well?
Actually, it had a 2-year maturity. He actually, I misspoke. He paid us off as soon as the yield maintenance expired. Once the yield maintenance expired, he paid us off early because he had already created enough value to seek lower cost of capital. But our general loan size is anywhere from 10 to 75 million. That was a $15 million investment. And we've done, since then, we've been able to do three additional transactions with that sponsor because of our ability to execute for him in a tight timeline.
Wonderful. And what are the interest rates that borrowers pay in this market, and what kind of fees do they pay today in general?
I mean, there's been a lot of yield compression across, all four corners of the real estate landscape. But for us, I mean, we're generally, L plus 550 up to L plus 8, depending on, our view of the risk, the risk profile of the deal. And it's generally one in and one out in terms of, origination fee, exit fee. And then if there's any extensions, you generally get, 50 to 100 bips for extensions as well.
Okay. So let's convert that for the lay person. L is LIBOR, which is currently under 50 basis points, maybe under 30.
I believe it's 15 to 20. I haven't checked. I apologize. I just got back from vacation.
Okay.
So I'm not as up to speed as I should be.
So L plus 550 would be a little under 6%, and L plus 800 would be 8 and change as an interest rate, right?
Yeah, we generally have floors anywhere from 25 to 100 basis point floors. So even with LIBOR kind of muddling around where it is in this low interest rate environment, we have floors from 25 to 100 basis points. So you could be 550 would probably be 575 to 6 on the low end, and L plus 8 could be all the way up to 9% if there's a 1% floor.
Got it. And how are your investors getting their target returns? Are you using structural leverage as part of your model? For example, if you make a loan at 6% rate, your investors probably want a return that's north of that. So how do you get them the return that they need? Do you use some structural leverage or not in your business model?
We do use some structural leverage, but we don't rely on it when we're pricing on the front side of a transaction. I mean, we have a target return, and it's just a target return, by no means, guaranteed. There's always a risk of loss. However, we generally shoot for an unlevered return of 8 to 10%. So with pricing, the origination fee, the exit fee, we're only looking at our initial term. We're not factoring in, well, we're definitely going to get extension fees or anything like that. We're only using the initial term, and we're generally solving for an unlevered IRR of 8 to 10%. And then after that, we do have leverage facilities that we have in place with various partnerships in terms of money center banks. However, we're not using leverage to manufacture our IRR. We're generally a very conservative user of leverage across our portfolio, just because of the transitional nature of the assets. The assets that we're financing are transitional by nature. The investment I spoke of earlier, I mean, the sponsor was buying that. It was probably high 70s, low 80% occupied, and the rents were below market rents. And he was gonna, the sponsor was gonna step in and do a light capital expenditure program, renovate the property, and kind of bring it in line with current market expectations as far as what other offerings in the market, and then be able to push rents. So it's a transitional asset, but we're not we're not necessarily, because of the transitional nature of these assets, we're not relying on leverage to get those returns. We're a very conservative user of leverage.
So maybe of the total capitalization, levered capitalization of your vehicles, is leverage less than 25% typically, less than 20%, or
It's
somewhere in that range?
generally, it's below 50%. I think historically it's been, below 50. I would say somewhere in 30 to 40%. Whereas a lot of other participants in the market or in the industry, you can read up on them. They're two, sometimes three, even four times levered on their book, and that's just not. We're focused on the downside. We're more conservative in that, just given that these are transitional assets.
Got it. Talk about your loan to cost and loan to value. How do you decide how much to lend on a given asset?
I mean, obviously, for certain asset classes that are more in vogue, we're willing to take a little bit more risk in terms of loan to cost, maybe low to mid, sometimes high 70s for an LTC basis. LTV, we generally cap out around 75%. Our target is 65 to 70. Obviously, given the current competitive landscape, for us to win some deals, we have to be accepting going north of 70. But those assets that we're willing to tolerate higher than 70 but lower than 75% LTV are generally those that have a more sound risk profile. I think a good example of that is multifamily or industrial, that you can look at the growth prospects of where they've been over the last 2 to 3 years, what's going on in the market today, as well as where the industry is heading, where the economy is heading over the next 3 to 5 years. Namely, this country has a significant shortage of housing supply, and with our shift gradually from in-person retail to online, you can see industrial being having a significant amount of staying power.
Okay, great. So let's look out 3 to 5 years, and knowing what you know about our industry and how things are developing, what do you see 3 to 5 years from now? Do you see non-bank lending continuing to grow? What do you see in the competitive trends? Talk about 3 to 5 years from now.
As far as non-bank lenders, I mean, there's already been a substantial amount of growth. As a result of Dodd-Frank and a lot of and just the lending regulations that were placed on banks, and then identifying other non-bank lenders that were very big as SIFIs, which is what happened at GE Capital Real Estate. It got labeled a SIFI, so it was subject to regulatory oversight, which kind of eroded their business model. You've seen a proliferation of non-bank lenders. There's been even during COVID, a lot of the equity shops have kind of pivoted to focus more on debt because they feel like it's how to protect themselves in the downside. I think in the next 3 to 5 years, as the economy continues its recovery and eventually gets back to where it was, I can see a lot of equity shops kind of realizing that debt isn't their bread and butter. It's not as easy as it looks, and pivoting back to placing equity investments as opposed to debt. So maybe the proliferation of non-bank lenders will start to ease a little bit, but I don't see non-bank lending as a whole. I see it capturing more market share. As the number of firms participating in the industry might not grow considerably, but I think market share, they'll continue to capture market share just because they provide a certain type of product in terms of it's bespoke, it's custom tailored for the client, and it's not subject to the regulatory oversight. So I think that the platforms that have a demonstrated track record and expertise in being non-bank lenders will continue to capture more market share, in my opinion.
And do you think that Calmwater's product set for borrowers will change and evolve in the next 3 to 5 years? And if so, what changes could you foresee?
Honestly, it's something that we're talking about internally. I mean, our bread and butter has always been, our niche strategy has always been timing and certainty of execution. And our investors have been very happy with that. And obviously, we want to keep that core investment strategy going because we think that there's definitely longevity there. As far as, potential other strategy that we could, we've just started those conversations, but we don't want to do anything that would take away from that core strategy. But possibilities could be, perhaps, a fund that's dedicated to construction, just so we're not having too much construction allocations we're always mindful of our allocations within the core vehicle, perhaps a mezzanine vehicle, perhaps, note on note financing. It's something that we've done in the past, but it's always been a small percentage of our overall portfolio in the core vehicle. So perhaps it's something that, we could launch separate managed accounts that just focus on that. But those conversations are kind of in their infancy. We're more focused on, we just think the core vehicle it's an attractive investment for our investors. So we're focused on continuing to work on that, to deploy capital along those lines.
Terrific. So what is one of your favorite things about the investment strategy that you pursue, or your job, or both?
The thing I like about my job is, I was in the military for 20 years. I had a brief stint in special operations. I'm kind of an adrenaline junkie. So I love that the deals that we do are fast moving. We provide a certain niche service to clients and understanding and really getting under the hood of complex investments that are fast moving. So, not only can we get those deals, figured out quickly, I get to travel around the country and learn a lot about every asset class. Some esoteric asset classes that are just starting to emerge. Life science is a good example. I've been able to learn about like land use laws in Brooklyn, New York. Just very esoteric land use laws across the country that I get to, because I'm kind of at my core, I'm a real estate junkie. So that's the reason why I left the military. That's the reason why I went back to grad school. I really, urban infill development is something that, is kind of a hobby or an interest of mine. So it's something that I get to learn, like, how localized, land use laws work. It's just, and I get to do that daily, and I have a great team, and we're a small, nimble shop, and we have a very tight colloquial family feel. So not only am I doing what I enjoy doing, I'm doing it with really cool people.
Great. And what about the risk for investors? What would be the number one thing, or maybe one or two things that could cause a loss of principal in your strategy, given that it's a more defensive strategy and you're the lender, not the equity? But what do you see as the scenario in which there could actually be a loss of principal with the type of strategy that you're pursuing?
Well, I think the things that we really drill into to kind of, gain high conviction that we're not going to have loss of principal are the sponsor's ability to execute its business plan. We really dig into sponsor track record. We spend a lot of time, because these are transitional assets. They're generally taking the asset from either, underperforming in its current, its current status and bringing it back up to market expectations, or it's, an adaptive reuse where they're taking an asset that was, maybe it's an older office and they're converting it to apartments or something along those lines. So we really dig into sponsors' track record, how many times they've done this, where have they done this, do they have experience with this business plan in this market with this size of project, and then do they also, are their incentives properly aligned? Do they have a lot of their own skin in the game, so to speak? Do they have their own cash equity in the game? Are they well capitalized? If the business plan gets delayed or there's a wrinkle, it goes sideways. Not only do they have the track record and the ability to kind of pivot, but they also have the balance sheet and liquidity to keep the project going if it's delayed or if there's a cost overrun. So that's kind of the first thing that we really drill into. And second, we're the debt. We're always looking at what the downside is, and we go into each investment with high conviction that there's a significant amount of basis cushion between what we think that if we had to step in to the borrower's shoes and own the asset and liquidate it, we want to make sure there's a significant cushion between what we think we can liquidate it for and what our last dollar loan basis is at. So if we think that we can liquidate it for $100 a square foot, we want to make sure that our last dollar loan basis is no more than $70, $75 a square foot. So even in, the most draconian of scenarios, we feel like we're going to get out without losing any principal.
Great. What's one thing that I haven't asked about that you think would be interesting for investors that are exploring different alternative investment options and subjects?
I think it's an interesting question, because it's something that I'm asking myself, is where, as an investor, can I deploy my, limited capital? And there's so much capital sloshing around the markets. And it seems like everything's overvalued. You talk about like, is there inflation around the corner? The stock market continues to go up. Bond yields are, I think the 10 years down to like, 1.15 last I checked. So it's where do you put capital? And, and I know like non-fungible tokens are, the next craze, and everyone's talking about cryptocurrency and stuff like that. But those aren't asset classes that I understand. And for me, I'm prudent, I'm conservative, maybe a little too much, but if I don't understand the asset class, I just can't see deploying my capital there. So for me, real estate is something I understand. Real estate is something that touches every part of my life. I live in real estate, I shop in real estate, I work in real estate, I travel in real estate. Like I'm staying in a hotel whenever I travel. It's something that I can understand, and knowing that I can put my money into a vehicle that invests in that there's an inflation hedge, because as multifamily rents go up, like the value of commercial real estate will go up. I mean, that's kind of one of the reasons why a lot of people are attracted to real estate. Now, from an equity perspective, it all depends on your risk profile, but from a debt perspective, where you feel like you have a considerable amount of downside cushion if there's a hiccup in the economy, and you're invested in an asset class that's generally regarded as an inflation hedge, that's kind of how I'm looking at it as an investor, as I deploy my limited capital, when I'm not working.
Sure. Okay. Next up, we're going to go back and we're going to do a layman's version of this. And imagine that your mom's friend is talking to you at a party.
Got it.
And she knows nothing about what you do, but she's interested and curious. So like, imagine, I'm going to ask you questions as if we're there, you, me, and your mom's friend who knows nothing about investing. And I want you to explain what you do in lay terms. So we're going to go back over the same things. Just give me fairly short, simple answers that answer the key questions. So, Paul, tell me about your job and your investment strategy.
Yeah, so I'm the head of credit and underwriting at Calmwater Capital. It's generally broken, which is a private debt fund, and we provide loans for real estate investors and developers that are buying or building real estate, across all of the different real estate types: office, hotel, not as much office these days, retail, apartments, industrial, which is warehouses, and we provide them financing so they can go out and buy or build the real estate projects. What I do, my business is broken up between the sales guys that go out and find the opportunities, and the credit/underwriting guys, which kind of dot the I's, cross the T's, and kind of peel the onion back just to make sure the investments that we're thinking about making, the loans, are good loans to make.
Terrific. And how much do you charge for these loans, and what are some of the other key terms of these loans?
We generally charge anywhere from 6 to 9%. In terms of the general terms that we kind of key in are loan to cost. So of the total cost, how much are we lending? So if there's a $100 million deal, we generally cap out around 75% loan to cost, which is $75 million onto that. And then loan to value, which is how much are we lending versus the value of the property. We generally cap out in the similar 70 to 75% loan to value, and those are, abbreviated as LTC and LTV.
And how does an investor make money in your strategy? How does an investor participate in everything you're talking about?
Well, the way we're capitalized is, we have 29, or 25 to 30 institutional investors, which is, pension funds, university endowments, and high net worth individuals that can, provide us, investments called limited partner in the form of limited partnerships. It's generally 5 million plus, and they would, when we fundraise, we go out and look for, those investors to hit it. We're generally looking to raise a certain amount of capital, 500 to 600 million, when we do fundraise, and you can participate in that by, investing in the fund, $5 million. It's generally a 3 to 5 year investment. And then from there, we generally try to provide, and our target returns on an unlevered basis, and they're just targets, they're definitely not guaranteed. There is always a risk of loss of principal, but our target return is, 8 to 10%. And historically, we've done higher than that.
Terrific. I'm Jan Brzeski, and you've been listening to Beyond Wall Street.